They've got a very high R squared, very high R squared. If you're dealing with any markets, and we had a chat about this when we were talking about gold and oil, the commodity markets, when you've got a market that's got a very high R squared, it means that you can lean more against them. If your R squared is a little bit ropey around about the 0, 1s, 0, 2s, 0, 3s, minus 1s, minus 2s, minus 3s, those kind of areas, it's a little bit more difficult to have confidence that what you're seeing is absolutely spot on unless it's got a very, very strong consistency about it. Well, we know that market internals have a very high R squared in terms of equities. It's obviously a stochastic in that sense. It doesn't have a trending element to it, so obviously on a macro scale basis it hasn't got a high R squared at all. In fact, it's got a terrible R squared on a macro because it doesn't go higher, it doesn't trend. So obviously if the equities are in a trend and you look at it from a macro scale basis, your R squared is going to be rotten. In fact, it might even start moving into negative territory the higher or lower the price goes. So when we understand R squared and we understand the kind of indicator that we're using, we can obviously time frame our analysis according to that. So when we think about market internals, we really are looking at today's highs and lows, also the net overall look at the equity markets. But generally, as a rule, we're looking at comparing highs and lows, swing highs and swing lows. So there's not a lot of point in me comparing yesterday's highs and lows. There's not a lot of point. It's a short-term daily indicator. So what I really want to do is I want to compare these highs. I want to start drilling down into these areas here at the top edge of my chart for today and see what today's market was telling us as far as these opportunities. Now, in terms of structures, it's very easy to spot the main structures. We can see the technicals. We can see the technical level, the changes of behavior very clearly. We can see the technical level here very clearly, and we can see the technical level coming into a top edge up here very clearly. So when we draw technical levels, if you simply draw in technical levels, you're already doing better than the vast majority of retail traders for obvious reasons. You're starting to see a slowdown in the technical highs. That's called compression. So as the slowdown starts, we go from 2 boxes wide to 1 box wide, technical slowdown. So there is already that element to it. It's not just a technical slowdown, but in terms of time, it's also slowing down. It goes 1 box to the right, 2 boxes up, 1 box to the right, 1 box up, 1 box to the right, no boxes up. Do you see how that simple conversion into that story starts to tell you about a top edge on equities? Well, what else do we look at? Well, obviously the internals. Let's take a look at what the internals were telling us yesterday about the possibility of a sell-off evolving. If we see consistent market highs, consistent buying at higher prices, we know we're in good shape because the market breadth is with us. But if I look at market breadth in this sense and I look at what was happening yesterday, I wonder if anybody spots the market breadth selling. Does anybody spot any market breadth selling on the equity markets? It's pretty crystal clear, isn't it? The market breadth started to diverge quite strongly in this area, and then it actually started to sell through these phases here. There was actually a very, very significant drop-off in any further upside participation, which tells me as a trader that I've got a great opportunity to start working offers into those higher prints. It's quite a simple job to do it. So when we start considering that, this is obviously the New York. We could do the same on the Nasdaq, of course, to see if the tech stocks agreed with us. And when we do the tech stocks, they actually they didn't just agree; they were very, very strongly agreeing with this storyline as it unfolded at the top edge up here, which is unbelievable. So we're in great shape for this sell-off. We've got the market internals 100% agreeing with everything that we've seen. And obviously when we look at some of the other markets, we could obviously look at the ABCs to see if they started to agree with this storyline. The ABCs should be an incredibly powerful positive correlation, of course. And these did not agree. The ABCs were still very, very punchy to the upside. So either the ABCs are wrong, or we've got to be trying to buy bottom edge equities. Well, we can't buy bottom edge equities. Why? Because the market internals say there's no buyers. So we can't buy bottom edge equities. So this is leading me to the conclusion that perhaps the ABCs are the market that's actually wrong on this higher high. We should be able to look at the ABCs or the J's and the S's and figure out who is wrong in that location. Perhaps it's the sterling highs that are wrong. We can maybe take advantage of getting some short sterling, or it's the Aussie dollar or whatever. What else? Well, of course, we look at the quality spreads. One of the most reliable little indicators that we can look at is the quality spread, and they kind of had a fair value read. They were very, well, not very bearish, but they were bearish at higher highs. This is a trending indicator. But they seem to not be too keen on this move higher here. They weren't too keen to show us anything. So we had a very fair value read on the quality spreads. Quality spread, because it is a trending indicator, allows us to do these longer term analysis. This longer term analysis allows us to make some pretty crazy reads. Now, does anybody now see what the quality spread gives us? A buy or a sell trade from yesterday's market. Now everybody goes, damn it. Precisely. So what's the lesson from this? What's the lesson from this? The lesson from this is you've got to look at some bigger picture. When we know the quality spread is that divergent, and we get a market that opens up into a commercial sell zone, the only time we can see that is if we're willing to go into the bigger charts. Remember, if I look at the internals, it's a stochastic-based process. It has a high bracket, a low bracket. It never really moves outside of those brackets. So you're not going to see that same quality using this, but this is a trending indicator. And because this is a trending indicator, your first job is to look at that and say, right, where did the commercial sell come in from? Well, we can see where the technical structure was from the day before. We can see where the top edge was at the as far as commercial sellers are concerned. There was a top edge commercial sell right there. Well, guess where the price went to yesterday? That commercial sell trade from the day before that. And that gave you your opportunity to start working into that very, very obvious sell. And how many people didn't see that? How many people were totally oblivious to the big macro that was evolving in the background? If you were, you need to fix it. It's like the gold trade this morning. If you didn't get the gold trade, but you're trading gold, you can't just shrug it off and say, oh, well, that's stupid. You've got to fix the things that you're doing wrong. You've got to fix the things that you're not seeing. You can't just say, well, let's move on to the next trade. Don't move on to the next trade because you're not good enough to move on to the next trade. You've got to figure out the one you missed first and figure out how you're not going to miss those trades again before you move on to the next trade. Just moving on means you haven't learned anything. So you've got to try and remember about these elements. How did I miss that sell from yesterday? How did I not know about that? Now, obviously, there's other things that we can obviously look at as well on a macro scale. We can look at the ABCs, and they were going off in the opposite direction. But the ABCs are distinct from the equity markets more than the internals are, that's for sure. The internals are very, 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 very internal, and the quality spread is based around equity indexes because it's the junk bonds of the equity indexes. So this black line has a far stronger positive correlation than the ABCs, which can have an interest rate narrative, perhaps the Canadians or the Aussies increasing interest rates, which might be negative for equities. So the ABCs is one of the looser lines that we obviously understand. We'd rather have it with us, but we don't need it to be with us, and we have to be aware of a higher interest rate environment that perhaps could be negative for equities, giving this a negative correlation, not a positive. So this is an incredibly important element. Now, other things we can look at on a macro scale are the internals, the value of some of the other equity markets. When we look at the value of some of the other equity markets, the ones we're obviously thinking about most often are going to be the likes of the pound and the euro. the pound and the euro markets. So we're looking at the DAX and the FTSE. When we look at the DAX and the FTSE, we're trying to figure out which markets are overpriced and which markets are underpriced. We can see at the top edge here that the market that seems to be massively overpriced is the FTSE. We can see the FTSE is massively overpriced at the top edge, and that's something that we want to be just mindful of, because obviously that means that the pound is obviously very, very strong, and it's helping out the equity markets in the UK, making them very, very expensive. And when you look at the market internals, that obviously becomes something that you could be potentially, as a foreign investor, that could be something you want to be shorting if you go into the short sale side of it. What else? Well, obviously, when we look at volume, for example, we want to know what the volume is doing. We want to try and figure out what the volume's doing, and there is absolutely no buy-side volume on the top edge equity pullback here. So that's a good sign to take into the bank as well, because that's obviously a very, very high positive correlation. What else? Well, obviously the volatility. In terms of volatility, obviously one of the key aspects of volatility is we want to tie these elements together. Volatility of volatility is incredibly important. So when we see volatility of volatility just turning off here, we can see that that's just enough for that sell to work into the bottom edges. But you can see it's been bullish actually for most of the last few days. When we look at the price of volatility, of course, this is also a macro story. We can see that the price of volatility was actually really bullish for equities, but they quickly adjusted to the downside. So the internal guys actually seem to get this one just a little bit wrong. They were pricing equities perhaps a little bit higher, and that's obviously not happened. And because of that, they've had to cover quite quickly and aggressively into that phase. But again, I like to put these two lines together. They're completely different lines, two completely different groups of traders, both very institutional, nothing to do with retail space. And if I can put those two lines together as a single line with a bit of market internals, I am happy to trade the S&P all day and all night, just using that information. It's the best quality information you can have. So we're getting close to today's cash open. We're 20 minutes ahead of it, and we'll get ready for the opening bell.